Omar Khan, how you doing today?
Not too bad, Juan. How are you? I am in cloudy Dallas today.
Cloudy Dallas. What's going on with that?
Man, we've got some rains and some cloudiness before we head into our nice hot summer.
Yeah, well, I mean, if they're anything like the Houston summers, then you'll be all right because we have a lot of humidity that we have to deal with
No, no, no.
every
It's
summer.
not like the Houston. It's way nicer, man. Way
That's
nicer.
all right. I've been here forever, so I kind of got used to it now at this point. Yeah. So Omar, tell me a little bit about your background and what you're doing now.
Well, my background is I'm a CFA, in a nutshell, I'm a CFA charter holder. That's 10 years. For guys who don't know what a CFA, it's basically like the gold standard in finance and wealth management. I have 10 years plus of experience across real estate and commodities. I've advised on about $3.7 billion of capital financing and M&A transactions. And I syndicate large multi-million, multifamily and other commercial real estate deals across the United States. Because I have an international background, I moved from Canada 2 years ago. A lot of my clients are high net worth advisors and entrepreneurs, not just in America, but in Canada, Dubai, and the like. That's me in a nutshell, man.
No, that's a pretty strong background, right? Wouldn't you say? So what are you doing now? Are you still focusing on underwriting?
Well, that's the bulk of my work because what had eventually happened is when I moved here, I realized that I had a great set of contacts that I was bringing in. So when I talked to a lot of syndicators that are my partners now, I wasn't necessarily fighting for the same set of local investors that they were. So they were more inclined to talk to me because my investors are all, well, not in their market, right? But the big pain point that I realized very quickly as I started working on a couple of deals was, underwriting. Everybody says you've got to be conservative, you've got to be consistent in your underwriting, you've got to have good systems. But across the board, what I was seeing was that this was a big pain point for a lot of people. A lot of guys, it's such a tough business to do, right? You've got to raise capital, you've got to talk to lenders. You're always on that hamster wheel of trying to raise capital, talking to lenders, finding deals, developing relationships. That a lot of these more, important, but, not as sexy sort of things, they tend to get ignored, or maybe ignored is not the word. They tend to get put by the wayside because it's not as pressing of an issue. And one of the things that I kept realizing, I kept running into over and over again was that the lack of discipline across underwriting. And the more partners I talked to, every single person eventually, they keep saying these things. And just for myself, what I'd done is because I have a finance and modeling background, I had created all these models for our own investment deals. So I was like, hold on, a lot of these guys would keep calling me up. These guys are running like 20, 40, 50, $80 million deals. They'd keep calling me up and say, hey, can you help me with my underwriting? Right? And I was a partner with them on a couple of deals. So I was like, okay, these guys keep calling me up all the time. They obviously respect what I do and the product that I give out to them. So I started working with a bunch of these syndicators formally on tightening their underwriting systems, going through all their PPM, seeing how they structured the deals and everything. And now what I do is, apart from raising capital and running my own deals, I exclusively work with syndicators and investors on underwriting deals, but not just underwriting deals. Now we talk about how to underwrite a deal. What are the big levers in your particular deal? How can we mitigate your risk? And really help syndicators and investors understand it's not the returns you should be focusing on, it's a risk that you have to be aware of.
Yeah, that makes a lot of sense. So tell me, what are some major key and driving factors that you see that are used in value add deals and things that people look at?
Well, first of all, this isn't just an underwriting example, although I wish it was. I feel like a lot of people tend to get too, this is a human. It happens to everybody, it happens to me as well. We tend to get emotionally captured in the deal, so we're emotionally invested into the deal. So we try to stretch the numbers to fit our investment criteria. Hey, if I just take down my expenses by 10%, or if I increase my rent growth by 2% extra, or, my exit NOI is, a little more aggressive. So number one, I think the deal is that pretty much everybody falls into this trap of emotionally getting vested into a deal. And the other deal also, from an underwriting perspective, I feel there's a couple of small little things that people are not consistent across the board, at least in my experience. Some of the good underwriting syndicators are exceptional at this, by the way. What we have to do is that we have to, first of all, look at rent growth. Then we have to look at exit NOI, caps. So these are basically things that are macroeconomic things. As an example, you can get a great deal in a declining market, but short of a miracle happening, it's not going anywhere. right? And if you get an okay deal in a super hot market, right? This market's only going up and it will go up. Well, a lot of your sins can be washed away. A lot of stupid mistakes that you did can just be washed away. And that's just the truth, guys. So the biggest thing we do before we even look at an asset, before we look at a sub-market, is to try to understand what are the macroeconomic drivers of a market, and are they going to be there in the next 3 to 5 years? As an example, Dallas is a very competitive market, right? Everybody and their dog pretty much is trying to syndicate a deal in Dallas,
Right. Yeah.
right? But the big game now isn't, well, can I buy an asset right now for a reasonable price that fits my investment criteria? Well, the big game is when I try to exit between 3 and 5 years, will the market be growing at as fast a pace as I have projected, given, looking at the past 3 to 5 years of data? Will the market be going at as fast a pace? Or if the market doesn't grow as that fast a pace, how does that affect my underlying valuation? And then how does this affect my returns? So those are some of the big factors one has to look at. And then we can talk about the micro level factors, that go into underwriting.
Okay. So there's some great points they brought up. So tell me a little bit about the common underwriting mistakes or things that, concerns that you see investors making all the time on a consistent basis.
So from a macro picture, it's just stretching the numbers to fit their investment criteria. That comes in many flavors. Right now, what I'm seeing in the current state of the market is revenue growth. Number one, it's historically, we project revenue growth anywhere between 3 and 5 or 2 to 6%, give or take in a market. 6% is ultra aggressive. Look, it's been happening in Dallas in the last couple of years, but is it going to happen? Can you bank on that happening year in and year out for the next 5 years? I doubt that's the case. Number one. Number two, the biggest.
Wait. Before you go to number two, tell me why that is. Why is it that you're seeing that be a common concern? Where are guys being ultra aggressive? And why is that?
Well, yeah, for the lack of a better term, guys are being ultra aggressive, and to a certain degree, I don't even blame a lot of people because look, because your competition is aggressively underwriting, right? So if your competition that's bidding on the same asset is aggressively underwriting and marketing at 5%. And, they might actually believe it. And hey, they might actually be right. I'm not saying they're wrong. They might actually be right. And you're being conservative, right? And you say, hey, I'm going to look at 4% or 3%, right? Because you're being conservative. Well, you're just going to keep losing deals. That's just the way it is. And there's no amount of, how good you are, how good you present yourself that's going to cover for that fact. So what happens eventually is everybody starts off being conservative, right? Because nobody wants to be not conservative. But when you start losing 3, 4, 5, 8 deals in a row, slowly what starts happening is that 3 becomes 3.5, that 4 becomes 4.5, that 5 becomes 5.25. And that's how you slowly start stretching the numbers.
Got it. Well, that makes a lot of sense. That clarifies it because, that's the number one thing is try to be as conservative as you can. But that makes a lot of sense where if you're losing a lot of deals, then ultimately you're going to try to make some kind of change. And that's where it can become a problem. It could be an issue where you try to be more aggressive and you get into deals that don't necessarily make sense. It makes sense to you on paper at the very beginning, but they're not going to be performing as well as they should on the back end.
I completely agree with you, right? And like we've talked about earlier before when we worked together, no deal is better than a bad deal.
Right. Yeah, I completely agree with that. So you don't want to get into a deal just for the sake of getting into the deal. That's not worth it. You get into a deal if it's underwritten properly, and of course nobody knows what the returns you're going to get. But that's why you got to look at historical data, right? Look at historical data, and you get all your ducks in a row and try to get it as best as possible, and then you move forward. Don't just go off assumptions. That's the wrong way to approach it.
Yeah, these things happen. We're all human. These things happen. But again, part of this is underwriting, but part of this is also emotionally managing yourself during this process because it can become very emotionally fraught. But the other big deal I also feel right now in the current state of the market is that a lot of guys a lot of syndicators especially, are aggressive on how much renovations they can do so they can get that renovated rent premium and how quickly they can do it. So a couple of the deals that I've looked at, guys are saying on a 250 unit deal, they're going to, ramp up their renovations to 75% renovations over an 18 to 23 month period. Well, that's cool if you can do it. But the problem is not a lot of property managers, even in that high level space of, 200 plus units, not a lot of them are going to stay on track. And that's just a fact. We've seen this across the board. No matter how big or small a construction project is, hardly does any construction project is ever on time or under budget. It just doesn't happen, right? So if you're very aggressive in your renovated rent premiums because you're renovating all these units, and then, the pace of that renovation goes behind your schedule, the rest of your underwriting for the remaining 2.5, 3 years, well, that just gets thrown by the way, right? Because now you were assuming, and each month on month, you just have to make more money to get back to where your forecast was.
Yeah, that makes a lot of sense. So don't go off of any assumptions, like you just said. You mentioned, okay, we're talking about the first deal was not to be over aggressive, and what was number two? You kind of cut you off on that earlier, but what was number two on that?
Well, number two on that is really trying to understand what are you trying to accomplish, right? And I'll give you an example. For instance, my father, he's 66 years old. So when him and his friends are investing, they're primarily investing for income with maybe a bit of, capital appreciation built in. So their model of investing is very different than my or your model of investing, right? I'm 32 right now. So when we're investing, me and my wife, we're looking at primarily, income. Yes, income's very important for us, but also how much potential capital appreciation potential do we have? So as an example, we might invest in a C-type property. Now, I know everybody says, I want to look at a C-type property in a B neighborhood with a value-add potential. Everybody says that. But guys, it's never a B neighborhood. Or it's not, I shouldn't say, it's not 90% of the time, it's not a B neighborhood. You're not buying a B or C-type property. You're buying a C-type property in a C neighborhood with value-add potential, right? So who you're targeting as a syndicator, it's very important. You have to know what kind of investor you're targeting. What are they looking for? And how can you help them get to that level? So if you're trying to get, say, guys like my dad into a deal, but me into the same kind of deal, I can tell you most times your priorities are just going to be going left and right? Your priorities will not be aligned with your investors.
Okay, so tell me about that. Now that we're talking about that, so tell me, how can a syndicator or somebody that's trying to be a sponsor on one of these deals, how can they cater to different types of investors? You just mentioned that you have your father that's in his 60s, but then you have somebody like you that's half his age. So how do you cater to different types of investors into your deals?
Well, I think first of all that really depends on your deal flow, how much deal flow you're getting, right? So if you have a track record, let's assume, and you've got a successful track record on that, and you've got a lot of referrals as an investor, well, a lot of these things become very easy for you to do, right? Because you have different types of deals for different types of investors. So you're not really, focused on just one deal and trying to raise money for it like a lot of people are. But if you've got one deal, and that's the only deal you have, and that's the only deal you're going to raise money on, well, it becomes very difficult, right? Because it becomes very difficult to say no to somebody who's going to invest $50,000, $100,000, $150,000 when you really desperately badly need to raise that money. But the counterpoint to this is a 3 to 5 year deal, guys. It's not like buying a stock. So for instance, if things didn't really work out, it goes down 10% and you need some cash, you can just press the sell button on your brokerage account and you have some cash. This is basically like, in a weird sort of way, it's kind of like a marriage for 5 years, right? And we know most people's marriages don't last for 5 years. So you want to go into a deal knowing, number one, that the partners you have, are they going to last the course? Because you're going to turn into so much headaches if you don't have the right equity partners that it's just not worth it, guys.
Got it. So we were just talking about how to cater to different types of investors. So, we talked about a little bit about age, right? There's a little bit of a significant difference on age. But what if you have an investor that's looking for a certain type of IRR, a certain number IRR, but then you have another investor that's looking for a certain average return or a cash on cash return? Then what do you do? How do you cater to all these different types of guys?
Okay, that's a good question. So number one, we've had this question asked to us a lot of times. And this comes in various flavors. Like somebody looks at IRR, somebody looks at average return, somebody looks at cash on cash return. But the one thing they all have in common is they're all only looking at return, right? Everybody's, in a weird sort of way, in a roundabout sort of way, everybody's just asking about returns. And right. What we tell a lot of our investors and a lot of our partners is, look, returns are very important. Don't get me wrong. That's how we get money. But we tend to focus on risk-adjusted returns. And what I mean with that is that before you get into a deal, you have to really realize, hey, what is the risk in this deal? And by risk, I mean, what is the risk in me not being able to get the capital that I've invested back at a bare minimum? B, if I say in my deal, as an example, on average, you're going to make a 15% IRR, just using that IRR example, right? Well, what is the risk that you as an investor have that you might not hit 15%? You might hit 13%. You might hit 12%. Well, is this deal worth it then for you, right? Because just as an example, you can show any number on a sheet, right? On an Excel workbook, any number can be shown because all you have to do is, change a bunch of variables and essentially your IRR will change to reflect those variables. So you really have to understand what your risk is and how can you mitigate that risk. And then once you've understood or at least have an idea of what your risk is, you have to compare it with your other options. So as an example, I have a friend of mine who I'm trying to get to invest in a couple of my projects. And the only reason why the guy's ever going to invest in my project is because he's doing pretty good in his business. And on average, he's making between 18 and 20% IRRs in his business, right? So when he looks at my average, risk-adjusted returns between 15 and 18%, that's just not a good enough deal for the guy, right? But I also have lots of clients who are on average making between 7.5% and 8% by when they invested in index stock in the S&P 500. Right? So for them, when they go up to the 15, 16, 17% IRR level, I mean, they're happy, man. I'm on their Christmas card list. Everybody loves me. Everybody calls me on my birthday. It's awesome. So it just kind of depends what your investors are looking for. How can you cater to that need? And well, then, trying to understand the risk around that.
Yeah, that makes a lot of sense. You basically have to find out what it is that they need. That's what's more important to them, right?
Exactly.
And it's kind of like we talked about earlier. Some guys are just looking at average return. They want to say a 10% average return every single time. As long as they're getting that, they're happy. Then then you'll find a deal that can manage. You can manage that. Then there's other guys that are looking for a certain IRR. I mean, you have to find a deal that kind of matches what they're looking for. That makes a lot of sense.
But as this process goes on, as we've had a lot of repeat investors as well, we try to educate a lot of our investors to realize, look, returns are great, as I said earlier, but think of this holistically. Think of this in returns, risk. Can you, choose to invest this money for 5 years and not get it back, at least the bulk of your money back in the first 3 years? A lot of these are constrained because it's very easy. Everybody gets really excited. At least a lot of my investors, because, I have a good track record. I've worked with them over a period of time. They know me. They trust me. So when I can pick up a phone and call them, I have a higher level of credibility with them, right? So they are more inclined to invest with me. But a lot of times, because I know them and I know their situation, I have to take a step back and say, look, I don't feel this is a good fit for your portfolio. I don't feel this is a good fit for you right now for XYZ reason. Now, they might say, no, I don't agree with you. And look, it's a free country. And so they can choose to invest with me. But at least you make your clients and your investors aware of what's going on and whether it is a good fit or not.
Yeah, that makes a lot of sense. So Tell me some examples on how you are able to help other syndicators. I know you've been doing it more at an institutional level. So I want to kind of talk about how you can help those single investors that are out there looking for deals right now.
So that's, right off the top, I'm actually working with syndicators right now on whose deals I'm not raising capital for or I'm not invested directly in their deal. And where do I bring value to them? Through my underwriting tools. Through the fact that I can underwrite more disciplined. You get an institutional quality underwriting, number one. It's more disciplined. Then once you do all the underwriting, the real value add that I bring to a lot of syndicators is, or rather our group that brings to the syndicators is, by we I mean our group, or by I mean our group. What we bring is that not only do we underwrite it for you and here you go, here's your report, and now we're done, right? And now take a fee and we part ways. I don't think that was value add. Right. What I think is real value add is when you do an initial underwriting and then you sit down with the syndicator and investor and go line item by line item to see, okay, where can we either improve returns? What are the returns most sensitized to? As an example, what particular factor? Like, we've done on a couple of your deals, right? Where we sit down, we talk about, okay, we've done the soft underwriting. What's going on? Which can we take the admin or payroll down by a little bit? Is the rent growth too aggressive? Is the exit NOI too aggressive? What is the interplay between these things? Because just getting a report is, I mean, without any context, I feel it's kind of useless, right?
Yeah. Yeah, and I'm going to interrupt you right there real quick. Yes, we have done a few deals, and we've underwritten them, and there's a lot of detail that if you don't have a lot of experience, then you can really miss out on some key steps that will mess up. It'll continue really affect your whole underwriting, and so you have to make sure that you're going line by line and being conservative, right? But you have to go off of facts. You can't just make up these numbers. You have to really do even more research to be able to know what to input into these different line items. And that's one thing that I'm noticing a lot of different people, that they're kind of just putting a number in there and they're seeing what other guys are putting in. No, it doesn't work like that. You can't just assume what and put in the number that you think other guys are doing. You have to actually find out what it is and that you should put in there and do your homework on that and go, like I said, line by line. And get the total at the very end. It's a very, very important that you do that. You guys do that, and so I've done it with Omar on several projects, and we've been able to uncover different ways to either improve, or we also found out that some of the projects that we thought were going to be good weren't at the end. They weren't good. So that was I can say that you've helped me a lot on that.
Oh, thank you very much. But the other thing I also want to point out is a lot of people that I'm coaching, right? Because a lot of people look me up through email, or a lot of people just give me a call. I'm just an email or a text message away, right? A lot of people that I talk to will tell me, hey, well, I have this analyzer or something, I either downloaded or a guru gave me or a mentor gave me or whatever. And, when I put the numbers in, it said yes, or the light was green. Right. And that's why I think the deal is a good deal. And, look, this is an example, obviously not examples like this. Right. But again, the idea there isn't whether the light is green or it says yes, or, whether you feel it's a good deal. Well, what's the context behind that thing? Is it light green or is it dark green? How green is it really?
Yeah, I like that. Is it light green or dark green? I would say it would be better to be dark green than barely light green, where it was just kind of like in a yellowish, light greenish. You want to be in a dark green. You want to make sure that this is a solid deal. And so now that we're talking about these other kind of different models that other guys have used, why do you think that there's a different? I mean, there's a lot of I guess you could say guru, the quote unquote guru. They've done many deals, and a lot of these guys have done a lot of deals. But then again, there are guys that haven't done very many deals. But why do you think that if they've done so many deals, why would theirs be any different than, say, maybe one like yours?
Okay, that's a good question. Number one, I don't necessarily think the way they've structured a lot of their models. I can't comment on that because frankly, I don't know every guru, so I really can't comment on that. And just to give you a disclaimer, look, a spreadsheet or any computer program, it's a program. So the good and bad part about any spreadsheet or computer program or any model is that whatever inputs you give it, it won't ask you questions. It will literally 100% follow whatever you're doing. So that could be a good thing, but it could be a very dangerous thing also, right? Because if you put in garbage, you're going to get out garbage. That saying, garbage in, garbage out. So number one, so that's a big disclaimer. Number two, what happens is, look, a lot of things that you download off the internet, they're great to help you get started. They're a great educational tool. And I highly encourage people to do that because at least, look, it gets you into the game, right? And you can start thinking things because you have, we all learn, the more deals we do, the more things we do, the more educated we become. But eventually what starts happening is that, look, guys who are working institutional, like, institutional shops, institutional shops are paying guys anywhere between $150,000 to $300,000, $400,000 a year just to make models, right? Just to underwrite. That's it. This is their only job. They don't go out to brokers. They don't have to deal with lenders. They don't have to do property management. None of that, right? None of that, right? And for instance, these institutional shops, they have a very sophisticated and refined way of looking at things, right? But look, if you're a syndicator and you've got to go talk to the broker, you've got to go find the deal, you've got to talk to the seller, you've got to arrange this, financing, you've got to talk to, your equity partners, you've got to manage the property, you've got to do all the due diligence, you've got to talk to the lawyers, accountant. I mean, there are a million things, man.
So essentially, you're wearing a lot of hats, and so that's one thing. I just cut you off again, but that's one thing that I know you guys should actually focus on is don't wear. At the very beginning, you're gonna have to wear a lot of hats. But as you become more sophisticated, as it becomes a more serious business, then you gotta take some of those hats off, right? Yeah. And then you gotta hire guys or have guys on your team that are great at those specific areas. So, for example, if I'm not great at underwriting, then have somebody on my team that's great at underwriting, right? And have another guy that's great at finding deals, and have another guy that's great at management or those kind of specific areas.
Mm-hmm.
I mean, you're good at several different things, but you're not great at everything, right? And so having a model like this or something that's great, or somebody like Omar that can actually help you out, and it's great, that has the background I think that's key, right? Because I'm not great at that, so that's why I have you as well as on my team to be able to help me out, right? Isn't that the way it is?
Yeah, and look, what we do is, like, again, compared to a lot of gurus and mentors, again, not trying to say anything because I don't know them personally, right? So this is nothing against them. We, as a group, bring a certain level of financial sophistication that is right off the top going to bring you credibility, not just with your lenders, not just with your equity partners, but with your brokers. Because if you don't get a deal, it doesn't matter how you finance it because you got no deal, right? So right off the top, we'll give you an institutional quality credibility right off the top. And a lot of guys out there, they can't do that because, look, either they're marketing people, right? Or they're great brokers, or they're great commercial agents, commercial loan officers. And that's nothing against them because, look, they have a specific role and they're teaching you about the product. What we are teaching is we have a very deep niche. It's a particular kind of syndication. It's a value-added syndication, D2C type property where you're going to have a certain structure. And that particular kind of structure only we can do in the market right now. Otherwise, look, if you're just going to go buy an apartment building, I would highly suggest you, hey, shoot me an email. I will teach you how to do that in less than 5 minutes. It's really not rocket science. Yeah.
And like I said, guys, I've personally used it and it's very, very detailed. I mean, you won't believe it's how detailed, how much more detailed it is compared to my other models that I have that I actually purchased separately. And so, yeah, I think at the very end of the day, to summarize the model aspect of it is, if you want to take this business seriously, then you have to be able to use a serious model. Don't use one of these cookie cutter kind of models. If you want to kind of do just one deal on your own and kind of see if it works out well, then yeah, maybe having one of these is okay. But if you want to take it to the next level and get investors involved and actually use investors' capital, and there's so many different moving pieces, then you have to use a more beefy and more sophisticated model.
Exactly. And again, the other deal is, look, guys, you can do this the hard way. For instance, I've spent over a decade. I spent 3 years getting my CFA, 4 years in the top global ranked school. You can do all of that. I mean, you can do what I did, because really, I mean, I did it. I think anybody in the world can do it. It's not that hard, I can tell you. Or what you can do is focus on something that you're amazing at. You're world class at that. And you can then get all the professional people to help you along the way. And look, that was my value add. And I'll be honest with you, when I was doing this business, I was capital raising, I was trying to find deals, I was trying to do all of this stuff. And very quickly, when I was talking to a couple of syndicators, I realized what their pain point was, because they'd keep coming back to the same thing. And I realized, okay, hold on. I do this thing naturally. This is what I do day to day. This is what I've been doing for 12 years in a row. So if I can do this 12 years in a row in an institutional shop, well, I can probably do it on my own. And that's what I did. I bought all my experience. I bought all that sophistication. So now when my syndication partners, and these are guys who are running pretty big deals, it's just a pain point that's taken off their shoulders completely. And they love me for that.
Yeah, because at the end of the day, no matter what we think about the deal, if it's, if we're not conservative, going back to the conservative, point again, if we're not conservative and we don't look at every single key and every single little spot on the model, then we're going to be in deep trouble. And we're talking about, we're not talking about, a couple $100,000 dollar deals. We're talking about a few $100 million. I mean, I'm sorry. We're talking about big money here. We're talking about a few million here, right?
Yeah, at least, the average deal that we're underwriting at the low end has been about $5.5 million. And on the top end, it's been about $30-40 million. So you can see when you're playing at that particular level between 5 and 40 million, but on average, our deal size has been about 20 million. There's a lot of structure that goes into our deal. That's just not like, hey, I went on Zillow, this house kind of looks underpriced, and I'm going to go buy this house. It doesn't work like that, guys. When you're dealing with investor money, when you're dealing with commercial assets, it's not just the assets. It's all the fees that go into it. It's all the tax structuring that goes into it. And these are things where you need specialized knowledge. You can't just get it by reading an article online.
Okay, well, that's great, Omar. if you had to summarize what we spoke about today, what would you say? Tell me some key major takeaways of our conversation here today.
Well, first of all, no deal is better than a bad deal, right off the top. Always be conservative, even though it can be very frustrating in the short term. And then at the end of the day, defense wins championships. So if you can understand your risk and you can manage your risk, the upside will take care of itself.
Got it. I love that, Omar, and those are great points. So I appreciate you sharing that. And for you guys out there, like I said, don't take this lightly. Underwriting and having the right models and having the right people on your team to be able to help you underwrite these deals is one of the most important pieces, if not the most important. So take it seriously. And like you said, having no deal is better than having a bad deal. So it's better for you to think for you to know that this deal didn't work out at the end than to proceed with it blindly and coming across some surprises down the road, and that wouldn't be good.
Oh yeah, I completely agree with you.
Okay. Well, I appreciate it, Omar. I appreciate you sharing your knowledge. I appreciate you sharing your wisdom and sharing some examples that really can help us out. And I thank you for that. And I wish you much success in here going forward. Where can we find out more about you if one of our listeners wanted to reach out to you?
Man, thank you very much. That's a lot of goodwill coming my way just with that message. So you can go to my website. It's boardwalkwealth.com. BOARD walkwealth.com, one word. You can sign up for our newsletter. We talk about everything under the sun, not just underwriting, the deals we're doing, what are some of the things, you should avoid, what are some of the things we've seen, just generally, So, and you can always email me at Umar at boardwalkwealth.com. So that's Umar, OMAR, at boardwalkwealth.com.
And what about your phone number, man? These guys are gonna want to call you, man.
Hey, man, just email me, and I can give you my phone number. It's in my email signature, and then we can start having a text conversation. I much prefer text, by the way.
Yeah. Well, there you go. Text. So definitely, you should be able to get his phone number off his website, and if you have any questions, then shoot him an email, and he'll be more than happy to help you out. So, Omar, once again, I appreciate it. Thank you very much for sharing your valuable experience, and wish you the best.
Thanks, man. I really appreciate that. And I'm looking forward to working with you on more deals.
Sure. Of course. We got to make it happen.
Yeah, we got to make it happen, man.
Yeah. Okay. Thanks a lot, Omar.
No worries. Have a good one.
You too. Bye.